Cool. Yeah, my name is Taylor, as I have told you previously. I'm going to talk today about transaction costs, social scalability, and the blockchain individual. So I wrote an article last year, some of y'all might have read about the blockchain individual, sort of speculating on the sociology of a world dominated by blockchains. Today I'm going to talk a lot more about sort of the why I think that's the direction we're headed. And I'm very much working through all these ideas right now, so I know there's a lot of smart people in this room, and I'd love any feedback and thoughts. Just on the computer. So I'll talk about transaction costs and why we should care, and some of the academic literature on that, social scalability and why we should care, and then look at those within the context of both the internet and the blockchain ecosystem. Background on me, I'm an independent consultant writer. That's my book. I have a site. I do some job placement stuff, and my writing has been on those places. So transaction cost. This is the only joke in the whole thing, so I hope it's good. So for the last 100 years, individuals have worked for firms, and by historical standards, pretty large firms. So there's a paper from an economist named Ronald Coase in 1937 asking, why is this? You know, if markets are so great, why aren't all transactions mediated by markets or all exchanged? And so his answer was transaction cost. That in the presence of high transaction cost, entrepreneurs will have people on permanent payroll in the form of firms instead of going out to the market for every transaction. So to take an extreme example, you know, if you're going to hire someone to answer every email in your inbox, you have to go identify the person that is specialized in answering a type of email. You have to bargain with them. You have to negotiate with them, and you have some enforcement cost to enforce that contract. So at a certain point, you just hire someone full-time or you do it yourself. So in the presence of higher transaction cost, we tend to get lower firms. Economy where you have very high transaction costs tends to be one dominated by large firms. And the lower the transaction costs are, the more efficient markets will be and the smaller firms will be. So as if you imagine a world with zero transaction costs and perfectly efficient markets, the economically optimal size of the firm would be one person. So the structure of the economy, sort of how these economies are organized, is based on these transaction costs. So what determines the structure of the economy in that case? And I want to say it's basically the technological paradigm. So there's an economist named Carlota Perez. She has a book called Technological Revolutions and Financial Capital. And so she lines out, these are some of the financial or the techno-economic paradigms we've moved through: the Industrial Revolution, the age of steam and railways, steel, electricity, and heavy engineering, and then more recently, the IT revolution, which she dates starting in the 1970s. So an example of how these technologies determine transaction costs, I want to look at the mechanical clock. So clocks were a necessary technological development to go from sort of an economy dominated by slavery and serfdom to one with jobs and firms. Before the mechanical clock, time was measured by celestial events, usually by sundials, the rising of the sun, the setting of the sun. And these events were trustworthy. They were censorship resistant to humans, right? There was no way to manipulate them. And so medieval towns in Europe would typically have a bell tower where they would toll out sort of important events in the day: the sunrise, the sunset, the opening and closing of the market, the time of mass. But this was limiting for a couple reasons. One, you had one bell tower, so you could only have so many events per day. If you wanted to have a lunch meeting with someone, you couldn't organize it based on the bell tower. You couldn't ask them to toll the bell for you. And then there was also accuracy issues. So, you know, something as simple as like a very cloudy day, you could be off by a large amount of time in terms of when the different events are. And so in the 14th and 15th century, most of the major European cities got an upgrade in the forms of mechanical clocks. And this is a diagram of an escapement. This is sort of the key piece that was invented that allowed mechanical clocks to work. And mechanical clocks were often supplemented by sand glasses. Sand glasses were often more accurate, but in some ways were less censorship resistant. It was easier for someone to cheat with them. But between the two provided a relatively fair, fungible measure of time. So each hour rung on the bell tower could be trusted to be the same length as any other hour. Most workers in the modern economy earn a wage based on some sort of time rate wage. You charge for an hour, you charge for a day, you charge for a week, 2 weeks, a month. So this requires some sort of fair, fungible measure of time that is relatively censorship resistant. Prior to the advent of the clock, you had an economy dominated by slavery and serfdom, in part because there was no way to sort of accurately account for this time. So mechanical time opened up entirely new categories of economic organization that previously had not been possible. So being able to go into the city for craftsmen to be able to negotiate, saying, I can give you an hour of my time for this much, and having a market develop around that time. So employers and employees could look at a standard independent instrument and verify that they were making an accurate transaction. So the clock is like one example of how this sort of technology can affect the transaction cost in society. The clock was able to bring transaction costs down because you were able to, in this sort of automated way, measure time. And pretty much everything we call technology lowers transaction costs. So writing, culture, double entry bookkeeping, all these things lower transaction cost. And this ability to lower transaction costs through social scalability, I think is the fundamental thing which enables what we call civilization. So this is an idea from Nick Szabo, who was an early writer on cryptocurrency, and particularly BitGold. And so if we go back and look at sort of early genesis of Homo sapiens, Homo neanderthalensis, the thing that seems to be unique about Homo sapiens was they were able to coordinate and through that get some social scalability, that they could work in groups compared to other genuses. And this was enabled by a larger neocortical size. So this is graphing some of the neocortex ratio among humans and other species. And humans were the largest and thus able to, or Homo sapiens, excuse me, were able to coordinate. And then, yeah, as I mentioned, Homo sapiens have been able to invent other technologies that reduced transaction costs. So culture, whether it's within a family, within a nation state, within a company, you're able to reduce transaction costs and increase social scalability because you have some predictive ability over how others will behave. But if you're from a common culture, you're able to more accurately understand how people will act. Another one I've been thinking about is double entry bookkeeping, that when you have your own copy of a ledger and someone else has their own copy of a ledger, you're more able to engage in trade. And there's some papers that have been written about the Renaissance sort of being possible only because of double entry bookkeeping. That all of a sudden you were able to have these much larger trade networks because you had a way to sort of reconcile the ledgers. And someone couldn't cheat, right? Like if you have one copy of the ledger, someone can just erase it and say, you owe me more money or I owe you less money. Over the last couple of decades, one of the big technologies that has lowered transaction costs and increased social scalability is the internet, primarily through matchmaking. So Amazon matches manufacturers and sellers, Uber manufactures riders and drivers, Airbnb matches people that have excess inventory in their homes and people that want to rent. Online dating matches people that might not have otherwise met. So just a quick recap where we are so far. The amount and type of transaction costs determine how the economy is organized. Technological paradigms determine these transaction costs, and lower transaction costs tend to result in higher social scalability. The internet did that through matchmaking. So I want to take a little bit of a deeper look at exactly how this happened on the internet, and then sort of what we can infer from that in terms of blockchains. When we talk about transaction cost in the economic literature, it's usually divided up into three primary types: measurement or search and measurement, market size, and enforcement cost. So low transaction cost, it would be very easy to measure things and search for them. Markets would be very large. And enforcement costs would be very low. It would be able to sort of guarantee that your contracts are enforced very cheaply. So a lot of this talk about sort of like the death of the firm was sort of common in the 90s, that the internet seemed like it was going to lower all these transaction costs and we were going to end up with this sort of world like Coase predicted, with very low transaction costs and very small firms. So the internet certainly lowered search and measurement costs, right? There's a whole industry called search that's all about lowering search costs. Think about Amazon reviews or just like consumer reviews in general. Also tend to lower measurement costs. Those tend to be more trustworthy than something coming from the manufacturer. And then at least for digital products or many of these software companies, you have very large markets. That if I have a company in Singapore, I can use a piece of software from someone in Boston just as easy as I can use a piece of software for someone down the street. Enforcement costs weren't really that much affected. Pretty much we still rely on the traditional legal system like we did before the internet. So I mentioned the internet reduced search and measurement costs and increased the size of the market. And how this tends to look in most internet ecosystems, this is a diagram from a site called Trajectory, is you have these large aggregators that tend to be a very high scale business. This is Facebook, Amazon, Google. They're able to serve very, very large amounts of customers for a very, very low price. And then you tend to have these, what you would call niche businesses or small internet businesses, where they're able to take advantage of the super low cost of running an internet business to reach a very narrow segment of people. And this is possible. This forms what's been called the long tail. So Amazon sells 488 million products. Walmart sells about 1% of that, or a little less than 1% of that. And Amazon's able to have such a large inventory because their marginal cost to hold another product page on their website is basically zero. And so they came out, there's a press release in the last couple months, about 50 to 55% of sales on Amazon are by small businesses. So it's not Procter & Gamble, it's not something you would see in Walmart, it's by this long tail, this yellow section of small businesses. And this was sort of an interesting like synergistic ecosystem. These two support each other. Let's see. And this, again, this was sort of possible only maybe mid to late 2000s, that until the sort of core internet infrastructure was down, these platforms or these aggregators were in place, it wasn't possible for these sorts of small businesses. And so I used to work for a company, there was about 15 people that had, we had manufacturing in China, we had distribution in North America, we had development in Asia and Eastern Europe. So this level of sort of global coordination was something that was previously reserved for large multinational companies. And then maybe about 10 or 15 years ago became something small businesses could do. So I'm going to give a specific example. I'm going to talk about authors and Amazon just because I understand it the best. This is a report from a site called Author Earnings that measures Amazon data for the book industry. And so as of September 2015, that's this one on the right, about half of all sales on Amazon in terms of books were indie publishers. So they were guys that were not working with a traditional publisher, guys or girls, that had published their books directly onto Amazon. And the economics of this are really interesting to me. So if you think about an author, someone that wants to earn a full-time living writing books, prior to Amazon, the way the industry was organized is you had a lot of transaction costs. And so it was very much this, what you would call like the fat head. So this very, very small segment of the market that was able to sell enough books to generate enough money as an income. So some rough numbers, like traditional publisher, maybe you have a book for $25, an author will get $1.50 to $3 of that. And so in order to make $100,000, you need to sell almost $1 million worth of books, like $850,000 worth of books. So on Amazon, the economics of this are very different. So if you're selling a book on Amazon for $10, an author will probably get about $7 of that. So you sell it for $9.99, you get 70%. So the sort of the minimum viable scale comes down a lot. That if you can sell $140,000 worth of books instead of $833,000 worth of books, you can end up with the same income because you're able to reduce all these transaction costs that are bundled up in the publishers. And so at least in the book industry, this sort of unbundling is happening, right? A lot of these people are going freelance, and you're able to do a lot more of this independently. So I guess, why don't we see this everywhere? Sort of starting in the early 2000s, there's been a number of books and people talking about this free agent nation. Everyone's going to be a free agent. A report from McKinsey showed something like 30% of the workforce in the US and EU is now, I think their terms was voluntarily engaged in independent work. So something like free agency. So it's certainly a thing that is happening, but doesn't really seem like it's taken off in the way a lot of people expected. So I think blockchain is going to play a big role here. So again, just to recap real quick, The amount and type of transaction costs determine how the economy is organized. Technological paradigms determine transaction costs. Lower transaction costs, higher social scalability. Internet reduced transaction costs through matchmaking. This brought down the minimum viable scale for digitally affected sectors like indie authors. And then in the book industry, this looked like a large aggregator. Amazon facilitating a long tail of self-published authors. So now I want to get into sort of the blockchain and what the implications there could be. So I guess the claim I'm sort of making, the argument here, is that blockchain is going to be a technology that takes this free agency phenomenon across the chasm. Two reasons. I think one is going to reduce or eliminate a lot of these new transaction costs that have been introduced by the aggregators, which I'll talk about in a second. And two, this sort of phenomenon of long tail economics is going to go just beyond sort of media and retail, which is where it mostly is right now with the internet, to a lot of other sectors. Today's aggregators lowered transaction costs for small businesses, but they certainly didn't get rid of them. So, in the case of Amazon, they take, say, 30% of a sale. If you're a small business that uses Facebook advertising, or customers find you through Google, they're going to take a cut of all those transactions. And over time, what tends to happen is as these networks get bigger, they want a bigger and bigger cut. Because they have more and more power over all the customers are on Amazon, and so you have to be on Amazon, and so they're able to raise their fees over time. In addition, I would say they sort of introduced this new cost in the form of what you call like stifled innovation or permissionless innovation. The sort of the irony of these large aggregators is they were able to build these very large businesses because they were building upon HTTP. They were building upon a protocol that they knew wasn't going to change. The rules weren't going to get changed underneath them. But most of the people that are building businesses on top of these aggregators, the rules can get changed overnight. Like Facebook and Zynga was one of the more common examples, but lots of times the biggest risk in these small businesses is effectively platform risk, right? Because you can get the rug pulled out from underneath you. And so there's a lot of companies that either haven't gotten started because of this risk or have failed because of this risk. And then there's also the other side of startups that are trying to compete with these guys and build similar sort of network effects that they tend to get either swallowed up or copied. So Instagram got swallowed up, Snap more or less got copied because the network effects are already inherent there and it's not that hard to copy the product. So the two things I mentioned I think blockchain will change is one, sort of getting rid of these new transaction costs, this sort of innovation cost of stifling innovation, and then also the actual just cut these platforms are taking, and then spreading this long tail economics phenomenon in a way that will increase social scalability. So how is it going to sort of solve the bootstrapping problem of these companies that are trying to compete? This is a chart. This is from Chris Dixon. He put this on a Medium article recently, talking about sort of this traditional network effect. You have this major bootstrapping problem where to get to the point where the application actually has utility is very difficult. And so currently these companies sort of tend to get swallowed up. Tokens or blockchains are able to issue tokens where you have this sort of inverse relationship. So if you were a very, very early adopter to Bitcoin or Ethereum, you were able to get a lot of financial utility out of that. And that financial utility is decreasing sort of as the application utility is increasing. So you're able to solve this bootstrapping problem. Very similar to the way like startups compensate early employees in equity. If you have equity, you're very incentivized to make the company successful because you want that equity to be worth a lot of money in the future. And so because public blockchains, and I'm talking about public blockchains here, are all open source, they are what you call like decentralized state machines. So it's possible to make a copy of both the protocol itself, but also the state. So the reason these aggregators today are so powerful is because the state is not public. That's their users' data, and that's sort of the zealously guarded asset. But in a sort of blockchain world, you could imagine that this state could be easily copied. So I think this idea of and I'm talking about forking, right? I think this idea of forking is interesting in terms of how much it really happens. I think conceptually, the fees and rights taken by these protocol aggregators, if you imagine them existing, would be limited by the cost of coordination to a fork. And it's unclear sort of what that cost of coordination is. But as that cost goes down, sort of the ability to seek rents goes down. As that cost goes up, the ability to seek rents also goes up. And then, so I guess that's sort of the first piece, right? That this idea of this platform risk or this margin that these aggregators are able to take could be dropped down by blockchains. And the second one is this idea of sort of the long tail economics going everywhere, or this aggregation phenomenon being much broader. So the example I've been thinking about is this idea of a niche underwriter or a niche mortgage. I have a friend in college, he didn't pay his credit card bills. He had a bunch of credit card fees racked up. He's now almost 40 years old. He's built and sold a business. He has another business which pays some cash flows, yada yada. And he can't get a mortgage from a bank because banks have this very fixed, if you think about that sort of fat head of books, they have this one particular way of analyzing risk. They have their one risk formula, and he does very badly by that because he has a history of missed credit card payments, and then his income can be variable year to year depending on how the business does. So, why couldn't you have, if all this this data is publicly available, why couldn't someone come in and write this sort of niche smart contract for a mortgage where you're able to build different sorts of models, sort of niche, he's a podcaster, you can build a niche mortgage contract for podcasters that's able to use data available from that industry. So you've got this many downloads and this size email list and whatever the factors you build into the model are. So yeah, this idea of sort of building these custom smart contracts that are able to extend the same long tail phenomenon that we saw with the independent authors into other sectors. So this is kind of the way I've thought about how this could play out. So this, on the left, you have the scale business and the niche business on the internet. But imagine this scenario where you have public blockchains that are sort of even further out in this tail in terms of lowering the cost. And then you have the blockchain man that is able to exist on sort of this very, very widely spread, low-cost platform aggregator. This is the other diagram I've been sort of playing with. If you think about minimum viable scale and transaction cost, that this in the industrial era, you had very high transaction costs, and so the minimum viable scale tended to be very high. And so you had only sort of this fat head of businesses that were able to exist. The internet brought those transaction costs down. I was sort of looking at that second chart of Amazon authors, right? You're able to lower transaction cost. And I think the blockchain is just going to bring this down further and also sort of expand the market where it's not just applying to retail and media, but a lot more broadly. And then, yeah, this is sort of my other diagram of this shift, right? So you have an industrial where you have a few large firms that are sort of mediated between them. The internet sort of started to break that up, that you had these individuals, maybe in the bottom left, a 3-person company that sold products on Amazon and used Facebook advertising, and then this world of sort of autonomous individuals, this very socially scalable world where transactions are mediated by blockchains, and this would be the blockchain individual. And that's it. So, questions? You just pass the mic around. Yeah.
Hey, Taylor. So one of the things I was curious about was that the transition from and giving individuals freedom as a result of the internet makes a lot of sense intuitively because it sort of uncoupled people from their physical location. Given that a lot of these massive platforms, like in the case of Amazon, have massive distribution, give individuals a ton of leverage by giving them all sorts of tooling to help them build up these niche businesses. Given that all of that infrastructure already exists and a lot of these mega-sized companies have significantly shrinking margins as it is. Yeah. What do you think is the sort of single thing that is most compelling about, this new transition from the internet era to the blockchain era that enables individuals to have much more leverage like they did from going pre-internet to post-internet?
Like, why would you move your business off of Amazon onto whatever blockchain?
A lot of the talk this morning was about decentralization. Like, I don't know if that plays a factor here, or what is the specific quality that enables that shift? Because before it was, internet allowed you to decouple, yourself from a physical location. Like, that was the killer feature. Like, what is the killer feature here that enables that shift?
So I guess I can imagine like one scenario where it just forms like a competitive pressure. Like, if Amazon keeps their margins at effectively zero for forever, it's going to be like very hard to compete with that. I mean, there's not like any rent seeking, so to speak. But I guess I think like talking to small business owners that run on Amazon, like platform risk is like what keeps them up at night all the time, right? If you have 70% of your sales over this like single channel, and that gets, you lose 50% of that, like you gotta go lay off all your employees. Like there's a lot of businesses that have been destroyed by platform risk. So I think, if you had some sort of marginally as good alternative without platform risk, that would seem very compelling. And that's basically decentralization, right? Like you don't have a central entity that could.
Got it, that makes sense.
Yeah.
Hey, so I had a question of, I understand like the two states we're looking at, like the current state where like there's Facebook, which owns everything, or Amazon, which owns so much customer relationship. And then you have this idea of, instead of having Amazon, how about we just not have Amazon and people trade by themselves? The question I have is, how do you get there from here? What dynamical shift will actually take you? I think this is related to your question about how you go from Amazon controlling everything to people just trading amongst themselves.
The way I've thought about it so far is, you're basically able to use tokens as this sort of like to solve this like bootstrapping problem. That if you sell forks on Amazon, and there's this new distribution platform where you don't have the platform risk. Why not also add that as a sales channel, and you're compensating some sort of tokens, which could potentially, or in theory, appreciate a lot. But yeah, I think that's a good question. I don't have a great answer, I don't think.
So I understand the part about how you have a really big platform risk when you're depending, and your business depends on something like Amazon, Google, and so on. But I guess the flip side of that is you look at a lot of blockchain projects, and they have a very strong tragedy of the commons problem. So like Ethereum is an example. Everyone wants to do an ICO. No one wants to work on a protocol. And this gets even more pronounced when you add in forks, right? Because the people that could work on a common blockchain get diluted across many, many forks. So I guess I'm curious, have you thought about that, and how maybe you, as like a freelancer or like someone, you're not dependent on these platforms that might do rent seeking anymore, but you're dependent on this infrastructure where you have huge potential commons problem, and where forking might introduce even more complexity into your business, right? Like if you're accepting Bitcoin and now you need to figure out Bitcoin versus Bitcoin Cash versus all the other versions.
Yeah, I think the forking question is interesting. I sort of like alluded to it without talking about it. But like obviously there's like a cost to fork, right? Like that is, you lose some of the network effect if, people are splitting off. So I guess the assumption I'm making is, if you have something at the scale that an Amazon or a Google or a Facebook is now, that's a sufficient scale that you could imagine some sort of fork coming off where there's still enough network effect and enough resources in a forked off ecosystem to serve some more niche use case. Yeah. Anyone else? Cool. Thank you all for listening.